Hello, everyone. Welcome back for my lecture on Chapter 2. So, in Chapter 2, we're going to really dig into the purchasing process. When we look at purchasing, we want to look at how it affects the organization, look at the way that it can affect profit. When you look at direct material and you look at something like this pen, the plastic used, the ink, the ballpoint, these are all the direct material pieces. Whereas the equipment used to manufacture this pen is going to be your indirect material. So when we look at this week's assignment, we did a break even, we looked at fixed and variable cost. In this pen, fixed costs are going to be your equipment. It's going to be the costs that are always there, and that fixed cost is spread out over a batch of pins, over a production run. Whereas the materials of this pin are tied to each specific pin. So you could have $100,000 in equipment, and that's your fixed cost, and then all your materials for a pin are a nickel. So that way, if you make a hundred, if you make one pin, your pin's going to cost $100,000.05. The more pins you make, um, that fixed overhead, the cost of that machine is going to be spread out over more and more of the units. So um, purchasing really does impact the cost of goods sold, otherwise known as COGS, COGS. Um, so the cost of goods sold is the bulk of it is going to be your materials and your PIN, but also some of it's going to be the processes and the overhead that go into making it. Some of those things that are in the break-even analysis that you're going to be doing in problem 9 of chapter 2. Um, so one thing I like to share is that when you look at how do you grow profit in a business, how do you make your business more profitable? Um, Everyone says, "Oh, you sell more." So I want you to think of it this way: if I am someone that is selling, I have this on my desk here, this kinetic sand that my kids love to play with, and I'm a salesman, and I go to Walmart and I make a deal that I'm going to sell you, 1 million of these containers and I sell them to Walmart at $1 a piece, and the profit margin is 10%. So I added $1 million in revenue, but I only added um, $100,000 in profit with all that effort. But if I'm in supply chain and I look at the um, kinetic sand that goes inside of this, and if this kinetic sand that is inside of this costs 50 cents, and on that same million units, if I can save 25 cents of that 50 cents, then I'm saving $250,000. So every dollar saved is a dollar in profit. Every dollar sold is a dollar of revenue. So I always love to tell my friends that work in sales that 100% of my efforts for profit improvement become profit. Only a small percentage of their efforts for profit improvement become profit. So I like to tell them, pound per pound, salary dollar for salary dollar, purchasing gives a lot of value to the organization. So as we go through this course, continue to think purchasing is more, supply chain is more than just the people that buy things. We are a valued part of of an organization. We can generate value, we can generate profit, we can bring ideas. So going back to some of the ways that purchasing impacts, let's look at some of these formulas that the book talks about. Return on assets. So the return on asset is quite simply your net income divided by your total assets. So you really want to have a maximum amount of income brought off by your assets. So if I'm looking at two product lines, and let's say I want to make pens and pencils. So I have pens and pencils. The pen you may be able to sell for $3 a piece. The pencil may be able to sell for $1 a piece, but you're going to sell 100,000 pens at $3 a piece, so $300,000, and you're going to sell a million pencils at $1. So there's more revenue off the pencil. But let's say you need, $500,000 for in equipment to make the pencil, and you only need $100,000 to make the pen. So then you start to look at it, and then you realize that your return on assets or your return on investment is much greater for the pen. So although you would sell more revenue of the pencil, you have a greater return for your financial assets on the pen. So um, while revenue is great, profit is better. And as a supply chain, we really can impact profit. The one way that we can do that is on the indirect side is buying the equipment at the greatest value possible, because then that the cost of that equipment is then that's what makes up your fixed overhead in your factory. Um, and that goes into your cost of goods sold. So if you can save a significant amount on your overhead on your equipment, then all of a sudden your cost of goods sold goes down, and one of two things will happen. Your profit margin goes up. So uh, you make something for $1, you sell it for $2, but let's say you can lower your cost of goods sold to 50 cents. Well, then all of a sudden you're making $1.50 on a $2 sale, or you can lower your price to $1.50, still make your dollar profit, but since you're so much lower than your competitors, you're selling more, and then that snowballs. So supply chain absolutely has more of an effect on the organization and on profit than just giving you the product to sell. We talked in the previous video about inventory. So we want to look at inventory turnover, and typically that is looked at inventory as a piece of sales. So in the text, it talks about taking cost of goods sold divided by average inventory. And then you really want to look at, is the inventory you're holding, is the capital investments you're making in inventory, is the way you're using cash in inventory, is it truly generating the most revenue that it can? You can take this and you can do it as an overall number for the business. You can look at it by the sellable product line. You can look at it at individual part numbers on the shelf and then decide your inventory plan based on how your inventory is performing. And then once you look at inventory, it's a very similar formula. If you want to look at it on a monthly basis, if you want to look on an annual basis, you just got to make sure that your numerator and denominator are fitting. So with the monthly number, you're going to look at your monthly cost of goods sold divided by your monthly inventory, or in an annual, you're going to set your calendar or your fiscal year. So as I'm sure you've learned in accounting, you have fiscal years and you have calendar years. So you're going to take what's been your inventory over your calendar or fiscal year divided by or your cost of goods sold over your calendar or fiscal year divided by your inventory over your fiscal year, and that gives you your annual number. So how do we get inventory on the shelf? Well, of course we buy it. That's when we invoke the purchasing process. That's when we call the people from purchasing. um, so so what is the purchasing process? Well, in the most simplest form, we identify a need, we find a solution, we negotiate the solution, we place a purchase order, and we receive the material, and then we pay the bill. There are some caveats. So when you're buying a large piece of equipment, when you're investing capital, you're buying a building, you're buying manufacturing equipment, you're buying laptops, you're buying a semi truck for your business. That has to go through a CapEx process, which is capital expenditure, and that's when you take a large purchase and you gain approval from stakeholders, be it executives or management or the financial or accounting parts of your organization. But if you go back to really, let's say we need something, um, that's when you conduct an RFI, which is a request for information, an RFP, which is a request for proposal, or an RFQ, which is a request for quotation. So they all sound similar. They are similar. They're a little bit different. So a request for information is really going to come into play when you don't really know a lot of what you're doing. It could be that you're venturing into a new product line. It could be that you're trying to innovate and you're going to rely on some expertise from the supply base. The RFP is, you know, I work for Logitech and I need to make a new mouse. I don't necessarily care exactly how it looks. I don't necessarily care what's in it or how it's made, but I care about how it performs. So you send a parameter of this is what I want, this is what I need it to do, and give me your proposals. Tell me how you would make it and tell me how much it would cost for me to have you make it. And then a RFQ is when you have a specific item that you need. So for example, I have these earbuds here, and I have a design. I know exactly what I want in these earbuds. And I send that out to earbud manufacturers, to third-party contract manufacturers, and say, I want you to make my earbud. It has to be to this drawing, to the specifications. It is my design. You're making it for me to my standards. And that's simply give me a price on what it would cost to do this. So typically, the RFP and the RFQ are going to generate the number that then you proceed through the purchasing process with. If you do an RFI, then that RFI will lead you into conducting an RFP or an RFQ. So once you know what it's going to cost you to make your mouse or make your earbuds, you negotiate your price, you negotiate your terms, and then you take that and you put in a purchase requisition. The purchase requisition is telling the organization, this is what I need to buy, this is what I want to buy, this is what it costs. And then it goes through an approval process. When it gets approved, then it'll become a purchase order, and that goes to the supplier. A purchase order is a contract. It is because in most states in the United States, most countries, an offer to purchase by the buyer, once it is accepted by the seller, then it becomes a contract. So typically, it's an informal contract, but if I write a PO and I have terms and conditions attached to my PO, and I send it to supplier ABC and they accept it, they have, unless they note otherwise, they have agreed to the terms of my purchase order. So that works in one-off situations, but when you're looking at someone that you're going to do business with regularly, that's when you want to have terms and conditions or an agreement, because the terms and conditions, they protect you, they protect your organization, but they also protect your supplier. And if you really want to actively manage your supply chain, you see your suppliers as partners, and you want to protect them just as much as you want to protect you, because you know what, you need them. If they make something for you and they go out of business, you could be out of business. So you got to view your suppliers as an extension of yourself. You need them as much as they need you. So um, terms and conditions, everything's negotiable. The Uniform Commercial Code is really kind of the gold standard internationally. So if there ever is a dispute in a purchase and it goes to court, oftentimes the courts or mediators will utilize the Uniform Commercial Code. And then when you look at your shipping, Incoterms are typically what's going to govern your shipping. It's going to determine where ownership transfers from the supplier to the seller, or the seller to the buyer. It's also going to look at who pays for transportation, who designates transportation. So, for example, if I were to purchase something from a supplier in China and I was used to use the Incoterm DDP, what that basically is saying is that the supplier has all liability for all cost arrangements and um, duties that are associated with the shipping, the insurance, and uh, taxes and tariffs, both at exit and entry. So they would owe all their taxes to the country of origin. They would owe all the taxes to the country of receipt. And then I do not take ownership. I do not take any responsibility till it is on my dock. So Incoterms are very, very important. Typically, you'll find that when you go to an organization, your organization is going to have standard Incoterms that you follow, um, but something good to familiarize yourself with. So, you really got to look at terms. They're going to favor the purchaser or the seller, and you try to do the best you can for your organization without putting your suppliers in a situation where they could really crumble as a business. And remember, everything is negotiable. So once you've agreed on your terms, once you've agreed on a purchase order, that you need to send your purchase order to your supplier, and that's done oftentimes via an EDI transmission, electronic data interchange. When I started my career, we would fax purchase orders to suppliers. They would fax them back with a signature. We mailed them to a couple. We had a supplier that didn't have a fax machine. He didn't trust them. He was an older gentleman, and this was almost 20 years ago. And we would have to mail him purchase orders, and if it was urgent enough, we'd actually have to drive them 30 minutes and hand them to him. Those days are gone. Most times now you're dealing with someone that has an ERP system, and you can have an electronic data interchange connection between your SAP, your JDE, your Oracle, and their system. And when you cut a purchase order, it transmits often via blockchain from one ERP to another ERP, and it'll actually then populate all the pertinent data from your purchase order into their sales function, which then sends that to the forecast to their MRP, and it really takes the room for human error out of the process. Um, that kind of segues into e-procurement. So there's a lot more things that are happening now as far as source to contract software solutions. Um, RFQ packages can be done electronically. You can have portals for your drawings and all your specifics. And then even in some instances, you may conduct purchases on a corporate card or a P card. Oftentimes, these are things where you're buying it from a one-off supplier, where you don't need the hassle of setting the supplier up in your system for a purchase order, or maybe even some suppliers that won't take a purchase order. I always give the example of, Roche, where I work, everything should be on a purchase order, but let's say we're buying pizza for the guys that work in the warehouse because it came in on a Saturday. We're not going to put the local Papa John's into SAP and cut a PO to Papa John's. The supervisor is going to buy the pizzas on his P card and expense it. So P cards offer a lot of flexibility to the organization. Typically, I don't recommend buying your direct material on a P card because then you lose your terms and conditions and you lose your protection by not having a purchase order. Um, you know, Another type of way to purchase is through a blanket PO. This is really common in services or materials that are repetitive. An example I use is, if we look at Lindenwood, if we look at a college campus, and let's say we have heaters and air conditioners all throughout campus, we may cut a purchase order to a HVAC repair company or an HVAC service company near campus, and that way, whenever somebody needs to come in and do repairs on the HVAC unit in the library or in the school of business or in the basketball arena, they come in, they do the work, and then they just invoice against that blanket PO. It's really a way of preventing urgent needs from being bogged down from the process of a regular purchase order. Um, So one of the main questions is this week in your assignment is looking at the make versus buy process, and that's simply understanding if it's financially viable to make it in-house or to buy it out of house, and look at that. And when you dig into that, it's that same equation can be used to determine if you want to buy it internationally or domestically. Often you'll hear the terms offshore or reshore. So really, it's a right sourcing exercise. Do I want to make it or do I want to buy it? Okay, I'm going to buy it. Am I going to buy it in the U.S.? Am I going to buy it in China? Am I going to buy it in Germany? So some of the reasons to buy, it can be cost advantageous to buy. You can actually um, you may have insufficient capital within your capacity within your factory, and you just simply don't have the floor space for equipment. You don't have the equipment, you don't have the man hours, so you need to go externally just to secure your capacity to produce it. You may lack the expertise and the know-how. You may not be able to produce it to the quality that you need, or um, your company may not have the R&D resources, and you're simply buying a product because it is innovative, it is something cool, and you're buying innovation to get yourself into the market. Some of the reasons to make, you could have that really great product that you don't want anyone else to make for you, so you're protecting your intellectual property. Um, there may be no suppliers that have the capability to make something as complicated as you want made, or they don't have the ability to make it at the quality you want. You may want to consider it for brand control. That goes back to quality. If um, you know, Coca-Cola, I mean, they don't have someone else make their Coke, but they may outsource someone to make Minute Maid orange juice, which they own. Minute Maid is not as core to Coca-Cola's brand, whereas Coca-Cola is. Um, and you may have existing capacity that you want to use and spread your overhead out through more revenue, thus allowing you to have a higher profit margin. So when you're looking at your make versus buy or your right sourcing exercise, um, what's the break even point? And that's the point at which, you know, that either one makes sense. So, we looked at the example in chapter 9. So for anyone that hasn't done it, I don't want to spoil it for anybody, but so you would look and let's say you have a fixed cost of $85,000 to make it and $35,000 to buy it. But you can make it for 10, or buy it for 12. So the way you'd want to look at this to try to find your break even point is you take your fixed cost for your make, and you find the difference between your fixed cost for your make and your buy. So in this case, the difference or the delta between the make and the buy is $50,000. So we understand that. And then we look at our variable cost. So what's the delta in our variable cost? Well, one's 10, one's 2, so it's 12. So it's a $2 delta. So when we divide our delta in our fixed by our delta in our variable, it gives us 25,000. So 25,000 is a quantity that is our break-even quantity. So when you take the 25,000 times the $10 variable cost, it becomes $250,000 in variable cost for the product. You take that same 25,000 quantity at $12 for buy, and it has a 300,000 variable cost. So then when you add 250,000 variable cost to the fixed cost of make, it's 335,000 for the total cost of the product. When you add the 300,000 total variable with the 35,000 in fixed for the buy option, then it becomes 335,000. So 25,000 then is your break even point. But if you were to decrease it to say 20,000, then it becomes more advantageous to buy the product externally, only by $10,000 in total ownership. But if you were to increase it to 30,000, it becomes advantageous by $10,000 to make it. So I would encourage you that when you're starting to work on this project and your homework, get an Excel, play around with Excel. Even once you find the answer for the project, um, plug in some different numbers. Just try to figure it out. See if you can learn, and just play with it a little bit. You may find it interesting. So part of this right shoring, make versus buy, is supplier selection. So one thing I really like to do when I'm looking at supplier selection is I want to involve my suppliers in the process as early as possible. Because at Roche, we know pharmaceuticals, we know diabetes care products, but we don't know plastic injection molding, we don't know equipment manufacturing. So we have suppliers that we trust, um, and trust your suppliers. You utilize them for a reason. What is the total cost of ownership or the total cost of acquisition, which we just talked about a little bit, but that's going to be everything from all the cost of goods sold to your logistics to your manpower. A good example is I may be able to have something made in the U.S. for $1.10. It may cost me $1 to have it made in China. So of course you say, oh, it's cheaper in China, but then when you figure to get it shipped from California to Indiana, it's 10 cents per product. So your cost to have it from the supplier to your factory is now $1.20 for that part from California. But to have that part shipped from China to a port in California is maybe 15, um, 15 or 20 cents. So then all of a sudden that dollar part becomes $1.15, and then it's that same shipment to Indiana at a nickel. And then you're looking at $1.25, $1.30 versus $1.20, and it's actually cheaper to have it made in the U.S. So you really want to look at all costs before you decide, is this something that is this something that I want to offshore? And that just goes back to the make versus buy process to understand your total cost of ownership. You want to ask yourself, can the supplier make it? Will the supplier make it? Can the supplier meet my cost, quality demands? Do they have the capacity to make it? Are they reliable? Where are they located? So cost aside, you may look at it and say, I really, really like this supplier, but they're located in Seoul, South Korea. And I just do not trust the situation between North and South Korea. And if North Korea ever decided to attack South Korea, I could be out of product. Um, I'm not advocating to not do business with companies in South Korea. I've actually had fantastic luck with them, but that was just an example that came to the top of my head. And then you want to look at the ease of doing business with a supplier. So is the supplier easy to do business with? Do they make your life easier? Are they reliable? So oftentimes you're going to be posed with the thought of, Do I want a single supplier for a product or do I want multiple? So when you're looking at the benefits of a single supplier, um, the single supplier, you can build the relationship and then you can use that relationship to leverage for better terms, for better pricing. With one supplier, you're going to have less variability in your quality, in your appearance of your product. Oftentimes, you can negotiate the lower price based on the relationship, based on them having all the volume. Um, you can have transportation savings because it's just one transaction. You're utilizing a full truckload, whereas maybe with multiple suppliers, you're utilizing less than a truckload, and less than a truckload costs more per pallet, typically, than a full truckload when you're looking at a per pallet basis. Um, if it's a proprietary product or a proprietary process, by having it at one supplier alone, you limit your exposure to risk. And typically, if you have a smaller volume, you want to stick with one supplier for that. You don't want to break small volume up over multiple suppliers. But with multiple suppliers, you may use that if you need capacity. If it's a very high volume part, that multiple supplier can mitigate risk. So you could have three suppliers making the exact same thing for you. One's in China, one's in Germany, one's in Missouri. And that way, if there's an earthquake in China, you still have two factories making it. If Germany gets shut down with the pandemic, you still have two factories making it. Um, and also, when you have multiple suppliers for the same part, you can create competition and leverage that for lower pricing. So I'm a firm believer in negotiating, and that you can use almost every opportunity to find a lower price. Because from a procurement side, I will tell you that the salesmen, the salespeople that you're dealing with, they will use every opportunity that they can to get a higher price from you. So you need to use every opportunity to get a lower price and bring that value back to your company. So the chapter then goes on to talk about how are we going to organize our purchasing department. And the two general schools of thought are a centralized versus a decentralized. I really do believe there's kind of a middle of the road where it's a little bit of both, especially now that we're really learning to work remotely. Anyone can work anywhere and still be kind of a centralized employee regardless of sitting in the same building. So really the concept of centralized versus decentralized, that's really rooted in at a time 10 years ago or so where the ease of working globally was not what it is now. So you can go into the book and it will break down some of those benefits of centralized and decentralized for you. Um, and then kind of global sourcing is the next thing it talks about. We've talked about different regions of supply already in this lecture, but just some things to consider. Um, you want to look at your import export process. Can you handle that internally? Do you have to hire a broker? So then if you have to hire a broker, you got to tack that on to every transaction and understand that as part of your total cost of ownership. You have to look at your travel. So if you're doing business if you're a US based company, you're going to do business in China. Um, you're going to have to go to China fairly regularly. Maybe not the same person every time, but someone's going to need to be in China. Or you may even need a local China office with boots on the ground, people that speak Mandarin. Typically, a U.S. company doing business in Europe with European suppliers, or a European company doing business with U.S. suppliers. That's not as often, or that's not as common to need that local office. But typically, when you're doing business, maybe in some of these emerging markets, some of these developing economies, that local office is a little more important because you do need local people on site to help support your suppliers, help grow your suppliers, keep them progressing and really develop them because it does benefit you to help your suppliers improve. So when you look at some of the reasons for global sourcing, we looked at some of those things to consider, but a benefit of global sourcing that I think often goes unseen is it gets your brand gets exposure in markets. So, China's not really an emerging market anymore, but Vietnam's an emerging market, or maybe Singapore or Malaysia. Some of these, Burma are some of these emerging markets where more and more Western companies are starting to source from. Well, it actually then allows your brand to gain reputation in their market. In the plumbing industry, Kohler was one of the first Western faucet toilet companies to start buying product from China. And as a result, Kohler is one of the number one selling plumbing fixture companies number one selling international plumbing companies in China. There's like Dalian and Loda. There's some local companies there that really have a stake on the market because they are local China companies. They face less tariffs. They face less regulation than a Western company. But there's a reason that Kohler sells significantly more than Delta Faucet, Moen, American Standards, because Kohler was there first and they captured that real estate in the mind of the Chinese consumer. And then government procurement is one of the last things covered in this topic. Um, when you look at government procurement, there's a lot more bureaucracy in it. There's a lot more transparency that needed. It's because they're spending our money as taxpayers. So we want to make sure that the government is spending our money properly. We want to make sure that it's being spent with integrity. We want to know that when they're picking a contractor, when they're picking a provider, they're picking it because it's the best product or the best price, or hopefully both, and not because the sales representative from this company took them to a baseball game or took them out to a nice steak dinner or gave them a watch. So we want to make sure that they're making decisions based on business practices and not personal practices. So really a lot of what we have as far as um, supply chain and procurement integrity processes do come from government purchasing. And a lot of that comes from the Federal Acquisition Regulation Act. And the DoD is really one of the biggest government budgets. I've worked at a few places that have had DoD, Department of Defense money, and the DoD requires that anyone that does business with them adheres to this Federal Acquisition Regulation Act. So if you do business with the DoD, you have to have an anti-gratuity policy. You have to have transparency in sourcing. So really, the federal government has brought some ethics and brought some of these policies that have made sourcing more transparent and a better department within your business. Um, one last thing that I'll talk about as far as government purchasing is when you are in an organization that supplies to a government entity at a high volume, or when you work in a government entity, there is a high emphasis paid on tracking the spend with small disadvantaged businesses. Um, and these are female owned, minority owned, veteran owned businesses, or also businesses that are located in historically underutilized areas. So this can be low income areas within the city, but it can also be underdeveloped rural counties. So there's some great portals that you can go on through the Department of Commerce, and you can look up a supplier. So let's say you have two suppliers, and they are willing to sell you the exact same thing for the exact same price. One is a historically disadvantaged business, and one is a major company. Um, Ethically, you can make your decision on how you want to go, but if all things are equal, you become more compliant for federal government purchasing, or make your organization more attractive to sell to the federal government if you're complying with the small disadvantaged business processes. So that was chapter two. I know it seems kind of crazy to roll, all that text into 30 minutes. Any questions, please reach out. Let me know. I'll be happy to discuss any of these topics further. But thank you all, and have a great morning, day, evening, afternoon.